Today's topic is making profit in low volatility environments and low volatility regimes, I call them. And if you're a trader right now, then you know that volatility is particularly low in the market. And well, why is that bad? Well, the reason why low volatility is bad is because there's not enough. How can I say this? There's not enough meat on the bone. Where volatility is really a measure of the range in pricing, right, during a day. During the day, price goes up and down. But if it's only going up and down like this, it's very difficult to pick a low price so that you can sell at a high price, or buy at a high price so you can sell at a low price. That range is so important because you can't always get the perfect high or low. You can get somewhat high or low, but let's say that a range is 10. You'll be lucky if you can get 1/3 of the bottom and 1/3 of the top. That leaves 1/3 in the middle. So if it's 10, that leaves 3 points. Now, if the range is 30 points, that leaves a third at the top, a third at the bottom, and actually you probably get a little bit closer and maybe a little bit better than a third, maybe a quarter at the top and a quarter at the bottom. That leaves half of that 30 or 15 points for you to make profit. So you can see that as your range increases, your ability to be able to, get something for it increases as well. Now, there are other things that get in your way, of course. There's this whole idea of signal to noise ratio, and I talked about this in previous episodes, where there's always a certain amount of hiss in the background, all right? And whether you're listening to a radio or television or a broadcast or anything else, or just, maybe you're in a crowded restaurant, right? And you're trying to talk to the person across from you. There's all this background chatter. And sometimes it's difficult to pick out your partner at the restaurant and what they're saying amongst all this chatter. So that's the signal that you're focusing on. And then there's all of this behind us and around us, this noise that is obfuscating that signal. Well, it's the same thing in trading too. You have this noise that's random, that is sort of out of left field, and you don't know what the hell's going on. And you can't see the signal. You can't grab a hold of it. You can't say, there's where I want to get in. There's where I want to get out. So signal to noise ratio is very important. In volatility regimes, there's also these sweet spots. There's sweet spots that work. There are these spots that are below a certain level that really don't work because there's, as I had said, not enough range. And then there's spots above there where it starts getting so chaotic that it doesn't work as well. In between there is the Goldilocks zone, what I call that sweet spot. And for us, if we were to measure that as traders, that would be somewhere, at least for the 0DTE stuff, I would say that is somewhere between a level on the VIX at 17 to 34. Now, that sweet spot changes over time. And that's what it's been since we had the big crash from the pandemic back in March of 2020. Before that, we had a very long period of time where volatility was very low, and the sweet spot was actually shifted down. The low part was around 15 or 12. And so the sweet spot was between 15 and 27, or 12 and 27 even. So now it's been, we've been sort of stepped up a bit. So as traders, we need to find, a little bit of that. We need that volatility. It is essential to what we do. And particularly as sellers of premium, it is very, very important. We need that. We need that because that's really what the premium in our options contracts are really based on: time and volatility. And these days, if you were to go into the S&P and you're going to sell premium on either the SPX or the ES mini options, you want some range in what's called the expected move during a day. And that's kind of how we judge how much volatility there may be in that market. And typically, in a typical Goldilocks scenario, we have anywhere from 25 points to 50 points of range. This morning, there was less than 10. All right, so if we go back to my example there of, trying to pick off a low to a high signal, and if you can only pick off the first third and the last third, and what's left in the middle is what you want, and then you have to then figure in also commissions and fees and the noise that we have to deal with, and there's only 3 points of opportunity there, that might even dwindle down to almost nothing. So in a market like today, I'd hate to be someone who doesn't sell premium, because at least with premium we have some edge, right? And time is on our side. So, however, putting on an asymmetric trade in order to put us into a position to collect that premium is just another thing that we have to deal with. So that is one of the reasons why this particular strategy is so effective. Because we're able to put on asymmetric trades, and this is really, I think, our advantage. We can put on trades with very small amounts of risk with a relatively large amount of reward. Now, you can't really do that unless you practice what we're practicing and you have some sort of edge to fall back on. In other words, this 0 DTE, the last day of expiration, where premium is falling off of a cliff, and if you're a premium seller, the rate at which premium is coming into you is much higher than any other time during the life of a contract, an options contract. Now, if we have enough movement in the market, then we can place a position far enough out of the money that we can have a relatively high degree of certainty that we're going to move within the range of that premium collection. That's basically how it works. If you look at Wednesday's podcast, I used my iPad, where I went over this in excruciating detail, exactly how we go about capturing large amounts of premium in this kind of environment. So the way we make money is we're looking for that particular combination of things. That last day where premium is decaying at its most rapid rate, enough volatility in the market so that we can have an expected move that would give us the ability to place an options collection strategy far enough away that we can have a reasonable surety that we're going to move within range of it, so that we can put on an asymmetric trade, so that we take very little risk and have a relatively large amount of reward. That's essentially how we do that. Our ability to be able to predict where price is going to go is central to that, and our ability to analyze the market structure underneath that aids in that prediction is really a big part of that. And I think that is part of our intellectual property, and that's why it works so well. In today's market, that really, what do we do? What do we do when we're at the low end of that Goldilocks zone or below it? Or what do we do if we're above it even? Although, like I said before, I prefer to be above it than below it. What we do is we modify our expectations. We modify them in such a way that we don't expect as much, and so we are less aggressive. We may take fewer trades. We may even skip a day of trading. I would rather not trade at all than put my money on the line where there is too high of a a percentage of times that I'm not going to be successful. The other thing that we do is, because we can't be as predictive, or because there's not enough range for price to move within our honeypot trap. We will create less aggressive premium collection strategies. So that means that there won't be as much premium. We'll have less time in order to collect that premium, and we'll have to rely on more movement when there isn't any movement. So that's all of this stuff kind of squeezes our opportunity. All right. I think that's that kind of explains exactly where we're coming from and how volatility affects us as traders. And there was a good point there. Carl says, sometimes no trade is a trade. In fact, no position is a position. And that's where we find us now. But I'll say this one thing, that because of the inherent edge that we have with premium decay and the way we collect it and the way we position ourselves, I can think of no other strategy that puts you into a place that even during these low volatility regimes, when other traders are struggling and losing big time, losing more than ever, when they're losing most of the time anyways, but now in particular when there's low volatility, most trading strategies are complete failures. Ours still works. In fact, our strategy during a low volatility regime works. Even though we consider it anemic, we're still making really good money. Really good money. In fact, we make probably an order of magnitude more money during our low volatility regime outside of the Goldilocks zone than all those other strategies make during their best times. So there's that. And that's one of the things with zero DTE. We get to put on trades and work in a strategy, in a methodology that has really no anxiety whatsoever. We're not sweating our risk. In fact, the old adage goes that you have to manage your risk. And the way we look at that is that if you're sitting there worrying about your risk all the time, then what happens with the profit? Do you manage your profit too? I mean, which one is it that you focus on? Do you focus on, and you'll see, and you watch just about any pro trader or retail trader, they're constantly talking about how they have to manage their risk. That is the secret to them making profit. Of course, we know that 98% of them don't make money. Well, we do something that is the inverse of that. We don't manage our risk. And the reason why we don't is that there's really no need to manage our risk. What we do is we manage our profit. Now, if there's no profit there, there's really nothing to manage. If there's a little bit of profit there, we can get it, and we get it consistently. In fact, our strategy on average returns about 150 to 250% return versus the risk capital that we put on. Now, that is kind of an outrageous claim, but it's true. When other strategies are trying to grab 4 to 15% of return versus their risk, there's a complete inversion there. But that's what gives us this sort of a different paradigm. We have zero anxiety in this method, and that is because we're managing our profits. However, we still reserve the right to say that this time kind of sucks compared to all the other times. It just so happens that our suck is literally 10 times better than their yay. All right. That's all I have to say today. And so I'm going to wrap it up. Otherwise, I start becoming repetitive. And Lord knows no one wants a repetitive Ernie. And I want to thank you very much for showing up. Next week, I'm going to be a guest speaker in a webinar that is being put on by my friend Dan Passarelli and of Market Takers. And this is the Traders Exclusive webinar series. And I'm going to be a featured speaker there. So I'm going to put the link down below. I'll just tell you right now what it is. It's 0-dte.com/webinar. So if you're interested in joining that webinar and seeing some of the other guest speakers there, register. We'll see you there. Take care. All right. Where's that off button? There it is. Peace.